Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 12th of June. I'm Daniel Lam, your host for the podcast. During the long public holiday weekend in Hong Kong a few days ago, I shared first place in a strong open chess tournament. In equity analyst earnings language, I beat the highest end of expectations, mainly because my last outing in the standard time control tournament was not convincing, and I was also ill during this tournament. Now, gold had been performing at the highest end of expectations in 2024, but it has shown signs of weakening. It broke below the 50-day moving average at 2,340 for the first time since late February. And technically, this opens the path for gold to test the 2,200 level. We noticed that gold market dynamics have moved notably, as until recently, gold prices were extending their gains on any supportive macro data releases, yet ignoring any headwinds or hurdles. This is a classic sign of a shift in market sentiment. And the reason why it managed to ignore any headwinds or hurdles was mainly because of the demand from global central banks. But that is coming under a cloud. For example, China's gold reserves were unchanged in May. That makes it the first month of quote-unquote no buying since China started purchasing again in November 2022. Now, China represented 45% of monthly global net additions on average. It was the largest buyer in 2023 and the second largest year-to-date in 2024. Now, as gold prices reach fresh all-time highs over the past 3 months, China's official sector gold buying has slowed, suggesting some price elasticity. Indeed, it only added 1.87 tons in April versus 23 tons 6 months ago. China has added 316 tons over the 18 months of consecutive buying. So gold now represents 4.6% of its total reserves versus 2.5% 5 years ago. Well, it is not wholly unsurprising that China's buying has drawn to a close. The current run has been the longest versus 10 months in 2019 and 2016. We note that the strength of official sector buying, including unreported flows, has been critical in setting a higher floor for the gold market, but also important in mopping up the surplus left by ETF net redemptions. So a firmer floor would also allow macro tailwinds to push gold to fresh highs. But should broader official sector buying ease, gold is likely to drift lower until Fed rate cuts emerge. So it believes in such an environment where investors are powering back on the risk hedging gold. This is a vote of confidence in the mix of growth and inflation, and positive for equities such as US technology and communication services sectors. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.